Welcome back to Investing Talk Podcast. Today, we're going to be focusing on Ambac Financial Group. You sent us some really interesting information about their stock performance, business overview, and some technical analysis. Really, our mission today is to try to unpack what this all means for you, the listener. So we're looking at some information about some price movements for the stock. It's showing a slight increase to 877, a pretty wide 52-week range between 1020 and 1844, and trading volume has been a little bit lower than average recently. We also have some information about how the company has shifted towards specialty property and casualty insurance. So let's see what stands out to us.
Well, right away, I think that contrast between the recent small price increase to 877, a 198% bump, and the 52-week high of 1844, I think that tells a story of some pretty significant price swings over the past year. So for you as an investor, this kind of volatility suggests that if you're considering the stock, you need to be okay with some potential ups and downs.
Absolutely. And then there's the trading volume. 74,304 shares recently compared to an average of over 500,000. That's a noticeable difference. What could this lower activity suggest?
Well, it could suggest a potential lack of strong conviction in the stock right now. Lower volume can mean that fewer buyers and sellers are actively engaged at the current price. Now, if we consider that some analysis suggests that the stock might be trading at a premium, this lower activity could point to investors being a bit cautious about jumping in at that valuation without more information.
That makes sense now. The technical analysis we have that gives a hold recommendation. But it also mentions that we're missing some data, like the 50-day and 200-day moving averages. And the RSI. Why is this missing data so important?
We'll think of these technical indicators as tools to help understand the stock's momentum and potential future direction. The moving averages smooth out the daily price noise to reveal underlying trends. The 50-day looks at shorter-term trends, while the 200-day gives us a longer-term perspective. Not having these makes it harder to see if that recent price tick upwards is a temporary blip or the start of something more significant. And the Relative Strength Index, or RSI, helps determine if a stock might be overbought or oversold. Without it, we're missing a key piece of the puzzle.
Okay, let's explore this premium idea further. The analysis mentions the stock might be trading at a premium, suggesting potential overvaluation. What does that really mean for someone thinking about investing?
Well, if a stock is trading at a premium, it generally means that its current price is higher than what its fundamentals might suggest it's truly worth. This premium often reflects the market's anticipation of future earnings, or the value it sees in a company's new direction, even if current financials don't fully support it. So for you as a potential investor, paying a premium increases the risk of the stock price falling if those future expectations don't materialize. So it really calls for some extra due diligence to understand if that higher price is justified.
Now let's talk about the company itself. Ambac started way back in 1971 as American Municipal Bond Assurance Corporation. But they've really shifted their focus to specialty property and casualty insurance through Everspan and Cirrata. That's a pretty big change. What's the core insight into why this shift happened?
Well, the core insight is likely a strategic move to navigate away from the challenges their traditional financial guarantee business faced, especially after the 2008 financial crisis. Think of it as a pivot to diversify their revenue streams and tap into potentially growing areas within the insurance industry. Essentially, they're reinventing themselves to find new avenues for growth.
And they're doing this through Everspan, which focuses on program insurance for commercial and personal liability risks, and Cirrata, an insurance distribution platform. How do these different segments potentially contribute to the company's future?
Well, what's interesting here is the potential for synergy. Everspan, by specializing in program insurance, can target specific, potentially profitable niches and manage risks more effectively. Cirrata, as a distribution platform, can make it more efficient and cost-effective to get those insurance products to the market. So it's really a move towards a more diversified and potentially more nimble business model within the specialty insurance space.
It sounds like a plan, but their recent performance tells a bit of a different story. Underperformance over the past month, a significant 28-81% drop over 3 months, and a 42-15% decline over the past year, compared to the broader insurance industry and the overall market. That stark contrast with the recent small uptick is definitely something to consider.
It leads us to wonder about the strength of that recent positive movement. That longer-term underperformance indicates the company has faced some significant headwinds. It really highlights the challenges involved in a major business transition and the market's potential skepticism about their ability to successfully execute this new strategy and achieve consistent profitability.
Let's delve into those financials a little bit. Revenue for the trailing 12 months is $275 million. But they have a net loss of $607 million. and an EPS of negative 13 cents. What does this negative profitability really tell us?
Well, negative profitability means the company is currently spending more money than it's bringing in. This could be due to various factors such as the costs associated with setting up these new insurance businesses, potential initial underwriting losses, or simply not having reached a scale where their revenues can cover their expenses in these new ventures. So for you, it's a critical area to watch as sustained profitability is essential for the long-term health and performance of any stock.
We also see a high debt-equity ratio of 12.5. That sounds quite high. What potential problems could this create for the company?
A high level of debt compared to equity means the company is relying heavily on borrowing to finance its operations. Think of a household with a lot of credit card debt compared to their savings. It can create financial strain. For the company, this can lead to higher interest payments, which can further hurt profitability. It also increases their financial risk, making them more vulnerable if the economy slows down or they face unexpected financial difficulties.
But it's not all negative, right? We see strengths mentioned, like their focus on the niche market of specialty insurance and the potential for growth in their P&C businesses. Can these positives outweigh the current financial challenges?
That's the key question for anyone looking at this company. The potential of the specialty insurance market and their strategic focus on building those businesses are definitely advantages. If they can successfully find profitable niches and grow those operations, these strengths could indeed compensate for the current financial weaknesses. However, it will depend on their ability to execute their strategy effectively and on favorable market conditions.
Now let's touch on how the market feels about this. It sounds like analysts have some mixed opinions. Some are seeing growth potential despite the current losses per share, while others are more focused on that underperformance. Why this difference in views?
Well, this split in analyst sentiment reflects the uncertainty inherent in a company undergoing a significant transformation. Some analysts might be more optimistic about the long-term prospects of this new strategy and its potential for high growth, while others are likely more concerned with the current financial realities and the track record of underperformance. This divergence highlights the need for you to do your own thorough analysis and weigh both the potential rewards and the existing risks.
And how does Ambac compare to its competitors? We have Assured Guarantee, MBIA, and Rating Group mentioned. How does Ambac set itself apart in this competitive landscape?
What's important to understand is that while Assured Guarantee and MBIA have stronger ties to that older financial guarantee market, and Rating focuses on mortgage insurance, Ambac's main differentiator now is its full commitment to specialty property and casualty insurance through Everspan and Cirrata. However, even with this different strategic direction, their current financial performance isn't as strong as some of these competitors, which is an important factor to consider when you're comparing them.
Finally, let's consider some of the underlying factors that might be influencing Ambac's stock price. We talked about the strategic shift. And the legacy financial guarantee business is still being managed down since 2008. How could what they do with this older part of the business still matter to investors?
Well, even though that legacy business isn't bringing in new revenue, how they manage it still has implications. Any significant unexpected losses or liabilities from that portfolio could negatively impact the company's overall financial health and investor confidence. Conversely, if they can resolve those older obligations successfully and efficiently, it could be seen as a positive sign.
We also have the general state of the economy and overall market sentiment playing a role. And it seems there hasn't been any specific recent news that's directly moved the stock price, suggesting the broader trends and the company's fundamentals are the main drivers right now. And we noted Morningstar's analysis suggesting a potential premium valuation. Despite all this uncertainty, it really shows how complex it is to evaluate Ambac at the moment.
What's fascinating is how all these pieces fit together. The market might be acknowledging the potential of their new direction by assigning a somewhat higher valuation, but the questions around their ability to execute and their current financial performance create that volatility and those differing opinions.
So putting it all together, you have a company in the middle of a significant transition, showing a recent small positive price movement, but against a backdrop of considerable underperformance and ongoing financial challenges. Their strategic bet on specialty insurance offers potential for the future, but there's still questions about whether they can achieve profitability and if the current valuation is justified.
This leads us to consider how much weight you as a potential investor would give to that potential future growth compared to the current financial realities and the skepticism we see in the market. It's clear that keeping a close eye on their financial progress and potentially doing more detailed technical analysis would be crucial.
We hope this breakdown has given you a clearer perspective on Ambac Financial Group. Remember to subscribe, like, and comment to let us know what other areas you'd like us to explore in our next session.